Hey guys, this is Crossroads here. Today I wanted to talk to you about the earnings week that we've had in three fintech names that I hold. I've got PayPal, Robinhood, and SoFi as well. Not so much talking about the full earnings and what I think about those. I've done those kind of a bit elsewhere in other videos, but I want to focus on what I believe most are missing with these earnings. So for each of them, there are two things where I think that are very positive that are overlooked or not even considered at all, and one that may be a little bit concerning or bearish as well. Now, we're going to look at these. I'll make sure I'll bookmark all of these. So if you just care about one name or two names, you'll have it right there. But in terms of earnings, like what I actually thought, I thought that PayPal's was very solid, but not like amazing or ridiculous. I thought Robinhood's was very, very good. And I thought SoFi's was exemplary, just almost a perfect quarter in terms of execution. So we're going to take it in order from the earnings that was very good, but or very solid in this case for PayPal, but not the strongest, all the way up to the strongest for SoFi. So for PayPal, there are two things that I think that the market's overlooking that's actually really, really positive beyond just headline numbers. One of those is, of course, that top line revenue growth specifically. So expectations were actually very minimal for the top line revenue growth, and they came in of course, at 5% dollar neutral. Now, part of that is that the dollar is actually neutral for once, which is nice. But what was interesting about this is expectations were for maybe 2%. The reason is this right here. And I don't want this to be forgotten. I think Robinhood should have, not Robinhood, but PayPal should have pounded the table more on this. Literally in second quarter 2025, they were expecting nothing, no growth from Braintree at all, or very, very minimal. There's actually a complete headwind in quarter one. Quarter four was a big headwind. There started the headwinds a bit in quarter three. There's a little bit left in quarter three. Quarter four, these headwinds dissipate. If you're not familiar with PayPal, what is going on is basically with Braintree before, which is their white label payment service provider. Previously under their prior CEO, Dan Schulman, they offered this almost at cost. And so while they were able to drive revenue immensely, they weren't actually able to add to the bottom line, which is a little bit silly if you don't have a strategy to make that pivot. So PayPal has gone away from that, having these conversations with merchants, which basically are lower volumes, so lower revenue overall, in exchange for healthier and higher margins, which is one of the reasons why margins have stabilized. And of course, transaction margin dollars continue to increase as well. So these headwinds, which they've made very known, it was about a 5% growth headwind, dissipate completely by quarter four, and a lot of that by quarter three. And so when your people are talking about the slowdown of revenue growth, think about it in terms of expectations and what is a very deliberate headwind there. This would have been 10% otherwise had they not made that shift, which is 10% the most amazing revenue number? No, it's not. But for a company like PayPal that has been around for more than 20 years, yes, double-digit revenue growth, it should be a goal, but just not at the cost of the bottom line. So that was something that I think was really kind of overlooked. Now, the other is actually related to this on the next slide or next couple of slides where they give the breakdown for these. And you can see here, of course, here's the payment service provider. That's Braintree. Only a 2% growth year over year. Last quarter, it was 1%. So that will continue to accelerate. I don't know that they'll get back up to 18%, but we should expect double-digit growth by quarter four, I would expect. And that'll be a nice benefit. But what I think the market is also sleeping on is Venmo. Now, Venmo is pretty exciting. You can just see here from second quarter 2024, grew 8% year over year, 10%, 12%. Venmo, by the way, when they describe it, it is the Venmo where you're sending money to other people. It's also Venmo debit and Venmo pay with Venmo as well too. So those are higher margin products than just when we send money to somebody else. Usually that's at cost. They don't really make anything from that. So why am I so excited about Venmo? Why am I saying that the market's kind of sleeping on this? Well, 12% growth is no slouch, especially when a lot of people had concerns with Venmo. And Venmo also, total payment volume continues to accelerate to the highest rate in the last 3 years. And what's really interesting is the direction that this will be going here in the near future. So let me go up to the Venmo slide specifically. Now, they did a great job of laying out these different modules where they're talking about all these goals that they have, how they're planning to meet each. And this was part of this under Scale Omni and Grow Venmo. 45% pay with Venmo total payment volume growth, 40% debit card monthly active growth, Venmo revenue growth overall was 20% as well, which is really, really strong. And again, Big 12 and Big 10 partnerships with Venmo, that's going to scale things as well. But the big unlock is this PayPal world. This is going to happen in January, where Venmo is able to be used at all of these places here. Previously, Venmo just in the United States. Now, anywhere, of course, where PayPal is used, but also any of these as well with your Venmo wallet. So that's going to be a huge revenue grower in the third quarter because of that Big 10 and Big 12 partnership and also what they currently have as far as the omni-channel. But in January, boy, that's going to really accelerate. I wouldn't be surprised to see Venmo, not just Venmo where you pay peer-to-peer, but Venmo overall growing at a 20 or maybe even a little bit higher percent clip within the next year, which is frankly very shocking. And it's awesome because at this point, it's not destroying the bottom line. It doesn't destroy margins. It doesn't compete head to head with PayPal like it was under the prior leadership. What a mess. And so they fixed that. Now, the bearish thing, this answer I did not like in the earnings call, but I do prefer the truth and I prefer honesty. And so I don't mind the way that it's answered. But there was a great question by an analyst from JP Morgan Chase, Tinson. He asked a question about that PayPal world that we talked about and Pay by Crypto. Now, when PayPal world was announced, I was like, man, this is a great accelerator for that Venmo opportunity, like I mentioned. And it adds to the TAM, but it doesn't sound like it's going to be a high margin thing. And when they announced Pay by Crypto, I'm like, okay, that's a logical thing that they need to do. It's good overall. It expands the TAM, but the actual amount that they get as far as transactions is 1%. So they do have a lower cost structure, and Alex Chris did talk about that when you are paying with crypto, and that's great. But ultimately, it is a lower margin thing. And so Tinson asked, and he said, hey, this is great, obviously, for TAM, but tell me about margins. He said, it's potentially a lower take rate. We've been getting a lot of questions on both sides. So how do you see it? And are you confident that both will be revenue and profit accretive as you push towards, I think you called it, interoperability quite a bit sometime as a release? So they focus on the TAM. It's very clear that this expands the TAM. It's great. It should be accretive as well, but it does hurt the margins as well. So that's one thing to keep an eye on as it relates to PayPal, as PayPal World goes out, as PayPal Pay by Crypto gains traction, is if it's displacing a lot of the cross-border trade that they have, it's not a great thing. Now, there's a lot of things going well with PayPal. You wouldn't know it by the stock, but that is something that I thought stood out to me as a negative. Didn't love the way the question was answered. Again, wish it was a different answer, but hey, I prefer it to be honest rather than just say, "Oh yeah, things are great," and sugarcoating it. All right, so Robinhood. Robinhood had very, very good earnings. Of course, I think 2 quarters ago was probably their best earnings ever. This was a very, very strong earnings as well. But there are a couple of aspects for Robinhood that I think are being slept on, and not all of them are positive. So let's take a quick look here at Robinhood. So the first of these, if we look at, I'll actually do the negative first. We can see funded customers right here in millions, and they added 750,000. Now this, you'd be like, wow, this is a great bump and great jump over here, but you have to know that most of these actually came from the Bitstamp acquisition. They actually noted it that if you look at it in the monthly breakdown, you'll see right here, 25.9 million active customers that are funded, just a slight tick up from the end of the prior quarter, and basically stable, no growth. That's not what we want to see. And then we do see this massive tick up right here of 26.95. Now the footnote here, it indicates right there that this includes 520,000 customers from Bitstamp as well. So in essence, if we go back to this number right here, there is a little bit of growth, but if it wasn't for that Bitstamp acquisition, it would actually be less growth than we've seen at any other point. Now, why is that? Part of that is they did have a month or month and a half where they had essentially no incentives. It gave us a good baseline read of what things would be like if they didn't have any kind of incentives as far as people coming over to the platform. There was a mention by Steve Quirk at the time that they were ACAT positive, so others transferring from other brokers, from every broker. That might not have been the case during that exact month when they had no transfer incentives at all. So this is not something to be alarmed about, but it is something to keep an eye on, is can they continue to grow and scale as they continue to put out, of course, other initiatives and marketing opportunities. I think that they will be, and thankfully, Robinhood can really afford to do this because of their vertical integration. They have a very lean cost structure. 90% of the costs are fixed, but that's not what you would ideally like to see in a scenario. You'd like to see them actually grow pretty well, even without incentives. It's not the case right now. So keep an eye on that. Now, there was two other aspects that I thought were really interesting and really bullish as well for Robinhood. One of those was specifically relating to security lending. So this is one of those areas that was a bit of a breakout and not an expectation at all. And there's actually a great question by analyst Devin Ryan on this too. Let me pull this up and we can take a look here. So total net revenues, and we see this massive increase in this gray area, net interest revenues, and we see a breakdown, not on transactions so much, but right here, net interest revenue. This is what we want to look at. Securities lending went up to 54 million. Now that is a tiny amount for Robinhood, simply because they're massive. They have a lot of revenue that's growing year over year, but that is the actual big surprise. If you look all the way back here, securities lending has not been this robust actually since back in the prior bull market cycle. Now, there was some really good color on this by the CFO, Jason Warnick. He went into this and he talked about this being very strong, and a lot of it is related to the IPO markets. It's related to some of the harder to borrow companies. Of course, they have more users as well that have more assets, and so there's more lending against that. And he indicated that actually in this month, July was equally as strong, if not stronger, than where they were before. So this is one of those areas that's going to be part of that $100 million annual run rate segment versus previously it was hovering barely above that. This is a tremendous increase, and it sounds like that's going to accelerate as well. That's just the flywheel working. So it's a nice little surprise. It's something that usually we don't think too much about securities lending, but maybe we need to start. There's also a very good mention there on margin and margin interest, although we won't talk about that too much. I don't think the market is sleeping on that necessarily. Now, the other place that I thought was very strong that Robinhood, that many people just overlooked, was with the share repurchases. So what am I talking about specifically is this right here. This is relatively shocking. So they said in the first year of the program, we repurchased 21 million of our shares at, basically a $34 average. And then they include the breakdown for quarter two, 2025, 3 million shares for 124 million at an average price per share of $42 in quarter two. Now, remember, Robinhood is now over $100 a share. So when exactly was this? Well, there were a few weeks in April, thanks to tariffs, where the stock price cratered, and it was right there at that 42 range. Robinhood, in essence, said, you know what? There's no reason to spread out our buybacks equally. This is a silly dip. We're going to buy the freaking dip. And they did it. This really just shows the operational excellence of Robinhood, plus in-house. Obviously, with the type of company that they have a lot of people that are savvy traders, that are technical analysts, that analyze the market and the macro. And I'm sure that they probably had some discussions and they said, hey, should we just go ahead and buy all of our buyback stuff in this quarter that we had planned to in this dip? And the answer was yes. That's the only way you get to that $42 average. Most companies are not really that aggressive when they see an opening. They tend to be a little bit more cautious. PayPal is one of those. They seem to just kind of even it out. Would have loved to see more acceleration and aggression there with the buybacks, but it is what it is. But Robinhood, boy, when they see an opportunity, whether it's buybacks or whether it's in the market or for an acquisition, they act. And I love that about Robinhood. So those are two strong things about Robinhood, and one that is maybe not quite as strong. Now, the last of these, but certainly not the least, is SoFi. SoFi just blew it out of the water in terms of expectations and where they actually came in. This was their best quarter ever. And it's hard to find much in SoFi not to like in this quarter. I could nitpick, but I'm not going to. There is one place that I want to show that perhaps the market is overlooking a bit. It's something to keep an eye on, not really a concern or a worry. But there are two places where I think that they really have underappreciated where SoFi is going. So let's look at the negative first and then the two positives. So the negative is on members. Now, new members, you can see, are still doing very well. No concerns with member growth. In fact, 846,000 new members is phenomenal. You look at this, it continues to accelerate. There is a cost to this, though. And the cost is really what I think that we should keep an eye on. Now, this isn't bearish, it's not terrible, but you look at sales and marketing, and we can see right here for this quarter, if we go up 3 months ended in June, and you can see 6 months ended here, they've really ramped marketing spend, sales and marketing. Now, obviously, it's working. You look at 44% year over year revenue growth. Now, part of that is against a weaker comp, but great. It's fine. The sales and marketing, a big part of that really is directed towards getting new users on the platform and growing that. And honestly, that if you look at the cost of acquisition for customers, now not all of this again is for customers. It's a little bit less effective than it has been in the past, and it's actually growing maybe a little bit faster than revenue. So that's not bearish. It's not horrible. It's just something to keep an eye on, that if we continue to see the sales and marketing expense climb more and more and it's being less and less effective in generating members, we might want to ask a few questions. But it's just a something to keep an eye on, not bearish, not bad. I just don't think that that's being fully appreciated as far as the expenses beginning to ramp, although deservedly so. If they continue to grow over 40% year over year revenue growth, no problem. Now, the two areas that I thought was phenomenally strong for SoFi, one of those was their product growth as well. So they have the financial productivity loop. All right, so here that is. And I'm sure if you're a SoFi investor, you're aware of this. They've talked about the flywheel and being a one-stop shop for a long time. And sometimes we see it, sometimes we don't. But as they continue to improve their product offering, as they diversify the product offering as well, that leads to more and more members getting more and more products as well. They specifically mentioned that they added a record 1.3 million new products. That's a 34% year over year growth. Here that is. So we actually see products growing at the same rate as we do members. That's good. Sometimes, and actually usually we see it less. Now, what's really interesting is we see new products, of course, outstripping new members, which is always good. If you don't see that, we have questions to ask, but they singled out and they said that 35% of the new products opened were done so by SoFi members that already existed. And so this is the productivity loop working. That part of that marketing spend, by the way, it's one of the reasons why we can't read too much into it, is to existing members like myself, where they're like, hey, you've already got a bank, you're already on Relay. Is it time now for a personal loan? Do you want to refinance your student loans, which I don't have? But so they do a great job of that. So keep an eye on that. Now, the other place where I think that is really interesting and stood out to me, but it seems to be slept on by the market, is over here on page 19. So this is the origination as far as loans and lending. And we can see the actual loss rate. They have the vintages right here. So as you go through with these personal loans, there's an expected loss range, and they're fine with anything under 8%. That's their calculations. And we can see that they're well under. That you can see that this actually flattens out over time almost always. This isn't a SoFi thing. It just, think of it naturally that if somebody has a personal loan that's 3 or 4 years in term, if they're going to default, it's going to probably be in the first year or two. It's not going to be like, you know what, I've made it all this way, I'm here to my last payment, and I'm going to let that become delinquent, and then that'll eventually be a write-off. That rarely happens. And so SoFi, I love that they did this, because a lot of people have said the way that they lend, their expectations as far as vintages are unrealistic, that they're not using fair value lending. And here they say, hey, if you guys are worried about this, in order to, and frankly, we shouldn't, we can see everything's going in the right direction. In order to surpass 8% life of loan losses on all 2020 and through 2025 originations, the remaining 40% unpaid balance would have to experience near 10% loss rates. Well, are there any of these that are experiencing anything close to that? No, it's not. So they're perfectly fine there. And just their sheer strength and brilliance in the way that the model works. Obviously, there's a demand for it as well with the loan platform business. But if a bear is saying, hey, this is a credible risk for SoFi as an investment, and it's something that is underappreciated, especially as consumers weaken and soften, which Noto gave comments on that, I think that bear case is way overstated as well. So there you have it. What I think has been overlooked for Robinhood, for SoFi, and for PayPal. very good to amazing quarters for each of these companies. Now, we saw market reaction is not always what we like to see as investors, but that's oftentimes short-term noise. The thing to do is really focus on the performance of the actual company, what they're guiding for. And all three of them are doing very, very well. And in particular, SoFi this quarter. Anyway, let me know what you think in the comments. Was there anything else that you felt like was overlooked by perhaps analysts or perhaps retail folks like myself that is not appreciated? Whether it's to the downside or upside, I'd love to hear it in the comments. And as always, thank you guys for watching, commenting, and subscribing. Till next time, happy investing.